Hello and welcome to episode 205 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, are you feeling festive?
I'm getting there, Andy.
Did you like the bells at the start?
I did like the bells. You know, I've managed somehow to get to the 20th of December without hearing the Pogues. I don't know how I managed it. I think I've just been head down. I don't know if anybody else has it, but I just don't ever feel like I cruise into Christmas. I just feel like Christmas ends up being stressful because you're trying to, you're going to take a week or two off. But I'm starting to get festive. I've even got festive baubles to stick in my beard, which I'm going to put on Instagram. But completely separate to that, I'm also buzzing because this week's podcast, we promised that we would talk about some really exciting stuff that's going to happen in 2019. So Andy, that is exactly what we're going to do. It's going to form a part of the show. We've got still some money stuff going on, but there are some exciting announcements, things we've been sitting on for quite some time, and regular listeners are going to be quite happy about it.
Are we going to do it at the front or the back of the podcast? Are we going to make them listen, or are we going to go straight into
it? Look, what we'll do is going to be a couple of very quick pieces, one on tax, one on property like tips, and an investing piece, and then this chunkier bit about stuff that's going to happen. So what we'll do is let's do a quick bit on investing, because we've come to the end of 2018. Now, there isn't going to be a podcast next week. We're going to come back with a podcast the second week of January, realistically. So this is going to take you through into the new year, this podcast, and then we'll come back by the second week of Jan. So I think it's quite timely just to pick up the last couple of bits of 2018 in terms of investing. So let's go straight into that. So I don't know if anybody, whether you've seen, Andy, about what's been going on in markets this week, but it's a case of grab your tin hat.
I'm in a privileged position this week. We'll talk more on why we are later, but I'm actually here with Damien live. The two of us are in the same room. It rarely happens. And I say I'm in a privileged position because normally I can't see his notes because we do things over Skype. And so whatever he's talking about, he's looking down at his notes from time to time and I can't see what he's looking at. I can see right in front of me a graph that's very much of a downward spiral. So I'm assuming the markets haven't been good.
No, I'm chuckling because, I've got somebody once asked, do I make notes when I do a podcast? I do odd sketch notes, so most of it I just go off the cuff, but on a rough agenda. But I have got some charts this week because it's almost, as soon as you start to talk about the market and you look up from the screen where it is lately, it suddenly have dropped another 1 or 2%. So I joked about the tin hat thing. So what has actually happened? Now, in the last week, we got to the stage where we had concerns about global growth. It's something that's been festering. We talked about it on the podcast. It's been slowly coming to the fore. It really was one of the reasons why the stock market had started to slump from October, and bond markets had been warning about it. And we talked about yield curves and the importance in previous podcasts. But this week, what we had is, in combination with even more confirmation, more headlines explaining and stating that growth is slowing all over the place. You'll probably have started to notice them. If you recall, a couple of weeks ago, I said, just keep an eye on any newspaper article that talks about economies anywhere, not just in the UK, and start to notice it's about slowing. And we had one about ASOS, actually, or ASOS, however you want to say it, about the clothing retailer, has had a terrible time, and its predictions of what will be over Christmas and its sales was so poor, their stock price fell 40% in a single day. Good. Now that is incredible, and that is just shows you what we're up against. But on top of that, what's happened is we've gone into a world where the central banks are trying to tighten monetary policy. And when we talk about monetary policy, we're talking about quantitative easing, aka money printing, and raising interest rates. And the stock market and all assets out there have a large part been driven by a flood of money, because when they thought the world was going to implode in terms of the financial markets or the global economy back after the financial crisis in 2008, they just flooded the place with money. So it was a bit like being pumped full of some medication when the economy was going to be in a coma. The problem is you've got to take the economy off of that. You've got to withdraw that drug, and that's what's starting to happen. Now, this week in America, the US Federal Reserve, which, remember, is the equivalent of our Bank of England, raised interest rates again. They've been on this steady path of trying to normalise things, head back towards something that isn't on the emergency side of monetary policy. So they're trying to get us back to somewhere that is actually sustainable, because the US economy had been growing really well, but cracks started to show, and we talked about that in bond markets and these headlines. But what's happened is despite Donald Trump doing his best and attacking Jerome Powell, who's the head of the Federal Reserve, on Twitter, which he shouldn't really do because they're supposed to be independent, but saying that if he keeps raising rates, it's going to cause a recession, or the economy certainly to slow down more than it already appears to be doing. Anyway, the Federal Reserve pursued their rate rise, which was telegraphed, but they didn't become as dovish as people thought they would be or wanted them to be in 2019. So they're going to carry on raising rates. So that was really like applying the anchors and pulling up the handbrake. So everyone's panicked that actually now the economy's slowing and they're raising rates. Now that's a bit like, if you want an analogy, if the car's starting to slow down and you're driving along, and you, instead of going down a gear or taking your foot off the brake or whatever, you actually shift up a gear. And of course, anybody knows if you do that, you're going to stall the car. And it's the same thing with economics. And so it caused the stock market to collapse in America. And I say collapse, it dropped about 1.5% after the announcement. But in the lead up to that, it's been going down and falling. And now Andy said about my charts I had in front of me. Now where we are is since October, the US stock market is down almost 10%, so almost in correction territory. But it was the last stock market really that was hanging in there. Around the world, we had the UK slumping and gone into correction territory. Loads of stock markets are in bear market territory. Correction is when it's down by 10%. Bear market is when it's down 20%. But now the US market is starting to play catch up, and it's down around 16% now. And this is going to start to probably feed through to other markets. So where we are now is people are panicking because we've gone through quite a few technical levels. And if you remember when we talk about technical analysis, it's when you see the squiggly line, the stock market line, there are certain levels you can see it bounces off, and resistance levels and support levels. And those are down to the way investors behave. So they may get down to, it might be a round number. So we talked in the past about 2,700 on the S&P 500. It gets there and then people start buying back in if the market's been dropping. But there are others that, for example, we had the prior low in 2018. So it's a case that the market started to fall previously but never got to that low. And of course you can imagine psychologically you're thinking, well, it isn't as bad as it was in February. So people have more optimism that things could recover. What's happened, we've gone through that low, and if you're setting lower lows and lower highs, that's a downward market, and the word bear market is coming up more and more. And I think where we are is going into 2019, everybody hoped we'd have a Santa rally. Now, we actually are in a scenario where this December is turning out to be the worst December for stocks, because December is usually one of the best months of the year because you get this euphoria into Christmas. It's the worst December since the Great Depression. And the Great Depression was in 1929. It was a period that lasted about 10 years. So we're going back a hell of a long way. We're almost going back 100 years. So it shows you the scale of the concern out there. And also, it's rare that we end up rising rates into potentially an economic slowdown. So we go into 2019, we're still worried about growth. We're still worried about China and trade. And for people who look at their own portfolios and wondering what to do, in the last few months, my portfolio for 80/20 Investor has got the lowest equity content it's ever had. It's got a strong cash weighting, around 20%, and some bonds as well. Now, that defensive nature has fared well. We did look like we might have had a bit of a bounce back at some point during December, but then that's fallen away. So going into 2019, Andy, I mean, if you want to know more about what the outlook is and the potential problems and then maybe the positives that we might have in 2019, and I'm doing a whole piece for 80/20 Investor members that will be published over the Christmas period, but it's going to be fundamentally focused on the bond market, the yield curve we've talked about, global growth prospects, and of course the trade war. So from a purely observational perspective, it's a fascinating time to be investing. You're going to learn so much when you watch markets now and when you see your portfolio and how it's behaving. Yes, markets do appear to be still in a downtrend that isn't at the moment dissipating or recovering, so be prepared for that. But it's interesting to see how people are reacting, and the bears out there are getting more vocal while the bulls are still really clutching at straws.
What would you say to those that are potentially new to investing? I don't know, they're going to make some New Year's resolutions and think, do you know what, I'm going to bite the bullet and get involved. What would you say to those that are a little bit cautious? Is this an opportunity, or is this something that you would maybe suggest to them, let it calm down a bit, let's see what happens?
Look, if you go to invest, you've got to appreciate the fact that the market is in a downward trend and could continue to fall. Now, in that scenario, we talk about drip feeding in, because if you put your money in slowly, like regularly, so you set it up so maybe once a month a chunk of your money goes in rather than all of it at once, and as the market falls, you're getting more bang for your buck, to use an annoying phrase. So you buy more units in a fund or shares that you're actually buying. The reality is the market could go lower. No one actually really knows we could suddenly rebound. But because of the sort of structural stuff in the background, and there's going to be worries about corporate profits in a world just like we had with ASOS, there people are worried that with consumers feeling the pressure if they start being laid off and they're not necessarily getting wage increases, and I haven't even talked about Brexit, then that does make it difficult. But it is an opportunity, because if you're investing for the long term, 10 years plus, then putting your money into work, you're better off buying towards the bottom of a market than the top, but you're never going to know when the bottom is. That's why doing something by a process is far better. But yeah, if you're going to get invested, just be prepared that you don't check your portfolio every day, because it's likely that you're going to start to see some losses to start with.
So yeah, stick to a process and use the smoothing effect that you talked about, and just have fun with it. Good.
And so we'll come back in the new year and we'll talk more about markets, because we'll see what's happened at the end of December and into January, because often they say as goes January, so goes the rest of the year, the first few days, and the stats don't really bear out, but it will be interesting to see what could happen in the investment markets.
Good stuff. So moving on to what we've promised you at the start, really, the fun stuff. There's lots of announcements, loads of exciting things happening in 2019 for Money to the Masses. Damien, what's the first on the list of the exciting stuff?
Well, the first one, and I struggle to recall if I've mentioned it, but we're definitely going to be doing a midweek investing podcast.
We did mention it once briefly, but we didn't go into detail.
No, so that is almost a side thing. I'm just making sure people have picked up. In January, we're going to start doing a midweek investing podcast, and we'll see how that goes and how much people like it. It'll be in this feed, so you don't have to go and find it. You'll just have a Brucey bonus every probably Wednesday with a podcast that drops in, which will be fantastic. It'll be a short podcast, probably aiming to keep it within 10-15 minutes, just talking about what's gone on in markets that week. We still will talk investing in this podcast, but it will be more evergreen like we try to do. The next thing I want to announce, actually I'm going to let Andy do this because it involves Andy, and anybody who has seen our social media lately will have seen us talk about our new office. Don't forget to send in your reviews and any emails, kind words basically, if you want to feature on our wall of love, which is the wall that we build with reviews and what people say about Money to the Masses. We've expanded into a big office, so Andy, you can take over.
Well, talking of that office, we're here in that office right now, and the reason I'm here is I'm super excited to announce that I'll be joining Damien full-time from 2019. I've got to tie up a few loose ends and finish off my current contract, but Damien signed me on a free. I'm more than happy to. The negotiations went well, and I couldn't be more proud and happy to become part of the Money to the Masses movement, because 2019 is going to be super exciting. So like it or not, listeners, you've probably got a little bit more of me.
Yeah, so when we do the podcast, we say email Damien at Money to the Masses. There's definitely going to be, you're going to email Andy at moneytothemasses.com as well going forward. So I'm so excited by it, because as we expand, and it's been something in the background, anyone who's listened to this podcast, Andy's been doing this podcast with us for, how long? 4 years. And now to come on board and to work for Money to the Masses and help us expand in so much stuff we want to do, not just involving the podcast, but the site and content, video and everything, is brilliant. And to be able to bring one of your best mates on board full time. So I'm going to have to look at Andy every day. He's going to be sat opposite me within the office of other people. So I'm really, really buzzing about it. So the good thing is, it means we're going to be able to do more events, because one of the things we want to do in 2019 is go out and actually meet more of you and go around the country. Well, that gives us much more scope for doing that if Andy is a full-time Money to the Masses employee with the relevant tattoo as well.
Yeah. Didn't mention tattoos.
Your face then, actually, for a second. So that is the first exciting part. Shall I tell you about the second?
Tell me about the second. What do we got?
Now, this is something that is for you guys out there listening. Now, Money to the Mess has been quite a long journey. It's been going for nearly 9 years. It was started off, as you know, as a blog that expanded into the monster that it is now, with about million and a half people a year using it. Now, we have so much content, and we have 80/20 Investor, which is a great product and people love. But we realise that when people interact with content online, what we're really good at is solving people's problems. But in a world where people are time poor, they don't always have the time or the inclination almost to follow things through. And there's also that element of serendipity that you've got to discover something, and also you don't know what you need to know. So if you imagine taking everything that is Money to the Masses, what's in my head and my belief about how people should be helped with money, we've spent a lot of time, effort and money, and we're now launching, we're rebranding the website that you'll see in about February, but in January we're going to launch the Money MOT. Now, it's Damien's Money MOT. You're going to see there's pictures of me. When we did the photo shoot, this was all part of the branding. And what it does is very quickly on a mobile phone or on the desktop, you answer 12 questions, multiple choice, very quick, anonymously. And what it will do, it will give you an MOT, a snapshot of where you are and how well you're doing. It will give you a score. It will give you a rating from A down to E. But what it does, it also tells you how you can improve your score. And it tells you how you compare against other people out there. Because one of the things that I have a real issue with, the way the world of money seems to work, is that you have people who call themselves experts who won't help you unless you pay them. So they will charge you a lot of money. Or the people you see out there who are maybe vocal in the media try and make people feel inferior. So rather than trying to help them just move from a better version of where they are, just one step at a time, they sort of make it, you've got to blow the doors off. They present a mountain you've got to climb so people don't change. It's all about the psychology behind trying to help people to move forward. If you imagine the 30-day money plan, the book that we wrote about 5 years ago, if you took the essence of what that is and then made it into an online journey, you'd almost like thinking it like an app. If you did that, 12 questions, boom, 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 and then you not only got a grade, you told you where you were going wrong, what you needed to do, what was most important, and trying to do that at the time. A bit like a car, you've got to make it roadworthy. It doesn't have to be the perfection, it's just got to be roadworthy, just to move you forward. And then not only will we tell you what you need to do, we're going to tell you how to do it. And that's where it gets really exciting. So we'll end up emailing you. You can say how often you want to be emailed, and you'll get an email that will tell you, right, this is one of the things that you are having an issue with. It could be to do with pensions, it could do with retirement, it could do with your credit, it could be with paying debt, every area of money, and it will send you through an action point of something you can do very quickly within minutes to actually make a change. And now that, I can't wait to get out there, because every time somebody takes it, it adds into the groundswell of the scoring that's in there, so you can benchmark people. And people, you often hear me talk about this idea of when you look out the window and you see that your neighbour's got decking and you think, I wouldn't mind some decking. It's the same thing with money. And I think this is going to be something we want to push people through. We want to encourage people to change their finances, improve their finances, but without judging them.
Super stuff. So do we have a firm release date for that, or is it just coming in January for now?
We've had the first version of it. It will be in January. It's more likely going to be the second week of January, but trust me, we're going to do big things with it in terms of pushing it out there. You won't be able to miss it. And we are looking to maybe do stuff that you may see in national PR, etc. But we'll let you know, and it will be featured on this podcast. So I'm so excited about it, because it is, if you distill everything we wanted to do into something that will be very quick, in 90 seconds, you get a action plan to improve your finances, then that is the dream. And I'd actually like to thank Justin, who's in the background, who's a big part of trying to make that reality. Having ideas and dreams is great, but turning things into reality, you need people with skills and the tenacity and the brains to actually make things a reality.
Excellent stuff. So let's finish off this Christmas special with a couple of final FYIs, if you like. We've got tax tips and something about property. Tax tips, Damien.
Yeah, I mean, I read a lot. and every now and then you come across something in one of the publications out there, and I think this one may have been in Money Week, to give them a nod. And I'm going to just read it out because I thought it was very good. It's a tax tip of the week, actually. And basically, if you're going to submit a self-assessment tax return and your liability is under £3,000, then you may be able to spread this payment out through PAYE, which is the tax that you pay, the tax system you use when you are employed, if you meet some basic conditions. And now, to be able to meet the conditions, you've got to file your tax return by the 30th of December, which is why it's timely, and I wanted to mention it on this. You must already pay your tax, obviously, via PAYE, either as an employee or on a pension, and your income through PAYE must be sufficient to collect the tax without you paying more than 50% of your PAYE income in tax, or paying twice as much tax as you normally do. If you go down this route, when it comes to completing your tax return the following year, make sure you include the amount of tax that was collected through your tax code on your self-assessment form. So it's a tip. Basically, rather than have a big tax bill in the new year, you'll be able to spread it out over the year, which I quite liked.
Excellent stuff. No, good tax tip. What have we got next? Property.
Now, this came, I'm kicking myself because this came via Twitter, and I was having a discussion. I'm very vocal on Twitter at the moment, and I'm having fun with it. And we were talking about property, and somebody said about, it was actually, I was talking about property prices and that they were falling. There was a piece in the press saying about asking prices fall £10,000 in a month. And actually, as I pointed out, well, all it was the reality that the price that people were expecting was way too high. And actually, house prices hadn't really changed, and asking prices are, in effect, a vanity number. And so we're in a world where property prices are coming down, and part of that will be because of Brexit, and part of it is just general nervousness and this time of year. And somebody mentioned a Chrome extension they use, which can actually track property prices. So when you look at a property, you can see if the price has fallen over a period of time, which was incredibly useful. And I remember probably a podcast we did, one of the early ones, we talked about something called Property Bee. It was an extension you could add. And I don't think it no longer exists, because this person said use Property Tracker, and you can download that as an extension on your Chrome browser, and therefore be able to see how a house price had moved or has moved in recent months. Or especially helpful if you're looking to move yourself.
Good stuff. So we're done for this Christmas episode. We are going to take a couple of weeks off for Christmas. We'll be back before you know it in January, and all of that exciting stuff will be underway. So enjoy your break. Please, if you could find the time while you're off, lots of people get time off over Christmas. If you can pop onto iTunes or the relevant podcast app that you use and submit a review on there, it just really helps us to help more people. That's what we're all about.
Yeah, and also if you're over the Christmas period, when you're sitting there on your phone, look at social media, look at Instagram, because we're probably going to start sharing some screenshots of the new Money MOT that we're doing. And that will be exciting. So you get a bit of a teaser ahead of the crowd before it launches in January.
And there may even be a picture of me at some point on Instagram, and you'll be able to put a face to the name.
There will be a picture of you, Andy, because we just took it.
Yeah, we did. So get in touch with Damien if you would like to do so. Damien at moneytothemasses.com, or Twitter, it's at moneytothemasses with a number 2. Damien, I've had a blast. Can't wait for next year. Genuinely can't. Cue the Christmas music.
Cue the Christmas music. Happy Christmas, and we'll see you in 2019.